Hello, everyone. I see we have some people joining the room. Our presenter is on time today, so we will have an on-time start. The presentation will start at 2:45. If you have any questions, please feel free to leave them in the chat, and we will try to get to them at the end of the presentation if time permits. Hey, hello, everyone, and welcome to our next presentation of the Investing in Alternatives Traders Expo, virtual expo. Next, we have Murray Gunn. Murray Gunn is the head of global research at Elliott Wave International and lead contributor on deflation.com. He worked as a fund manager in global bonds, currencies, and stocks, including long posts at Standard Life Investment and the Abu Dhabi Investment Authority. Mr. Gunn then joined HSBC Bank as the head of technical analysis. He is the author of Trading Regime Analysis and a contributor to Socioeconomic Studies of Society and Culture. In April 2018, Murray took over. He took over the helm of the European Short-Term Update. You can also read his commentary in Global Market Perspective, Interest Rate Pro Service, and Currency Pro Services. Without further ado, ladies and gentlemen, Mr. Murray Gunn. Murray, the floor is yours.
Thank you very much, Marquise, and welcome everybody to wherever you are in the world today. Thank you for coming along and listening to my presentation. So, as the title suggests, it's the case for an 8.5% T-note yield. As Marquise said, I'm from Elliott Wave International, and Elliott Wave International has been around since the late 1970s. And as you'll see, our process is a very unique process. If you want to learn more about it, elliottwave.com is the place to go. But just to sort of give you a flavour of how we view the world and why we're coming to this conclusion of a big increase in the T-note yield, which, by the way, no one else really is talking about at all, as far as I can see in the world. Our unique process really revolves around the fact of what drives markets. Now, most people in the markets. And I've been around since the early 1990s in the markets, seen all different types of people in the markets. Most people would say it's either economic data that drives markets, drives the stock market, the bond market, etc., or the cliche is that earnings drive the stock market. It's all about the earnings. Well, if earnings are going down, the stock market's going down. If the earnings are going up, the stock market's going up, etc. We take a kind of different view. Our view is that it's people that drive markets, because people are making buy and sell decisions, and to not make a buy and sell decision, to just to hold and not do anything, that's an active decision as well. So it's people that always drive markets. And why is that important? Well, because human beings have a tendency for herding behavior. They're non-rational. People are rational on their own, but non-rational, as we call it, in crowds. And this is why crowds, which is the stock market or the bond market or the currency market, exhibits herding behavior. Now, herding behavior is patterned and predictable. I mean, you just have to watch the news at night to see riots, or even we're watching the World Cup at the moment. You watch the supporters at the World Cup. That's an example of herding behavior when everyone's doing the same thing. But in terms of the markets, what we found with herding behavior is that price tends to move, the price of the bond market or the stock market tends to move before the news comes out. And this is why it's important that we believe to follow the price, which is the manifestation of herding behavior. That's the price, the closing price of the day, and that's why we follow it. The bottom line is that people have asked me over the decades, what do you believe moves markets? Well, I believe that human beings move markets, and that's why we study people. Okay, and we're quite unique in that regard, and especially because the model we use is called the Elliott Wave Principle. And as I said, ElliottWave.com is where you want to go to learn all about the Elliott Wave Principle. But this is the basic measurement of, or a basic design of what Ralph Elliott, this chap here, what he discovered in the 1930s through a study of the stock market data going back a number of years from the 1930s. And what he discovered was that markets tend to move in patterns, and he called them waves. He found that there was a limited number of patterns in this, and crucially, that they're repeated at every time frame. Okay, so what Elliott discovered way back in the 1930s was that the stock market, or any market, anything that's driven by human beings, is what we call a fractal. And this was decades before the chaos theory came to the same sort of conclusion. But Elliott also discovered that the waves are often related by natural mathematics, and specifically related to the golden ratio, which is all around the universe, of 1.618. So this is the stylized graphic of the basic design of the Elliott Wave Principle. If you want to know more, and there's much more to learn, and we're not going to go into much detail about it today, but ElliottWave.com is where you want to go. So that basic design of the five waves up and 3 waves down, this is what we saw as an example, as a real world example. This is the German Bund 10-year yield back in 2020. And we saw a 5-wave movement here in the brackets, 1, 2, 3, 4, 5, and an A, B, C down. So 5 waves up and a 3-wave correction. And then the market continued in the same direction as the initial 5-wave movement. And identifying that particular, at that time, allowed us to say to our subscribers back in September 2021, we suggested Auf Wiedersehen to the German Bund yield, kiss goodbye to low yields. And this was when the German Bund yield was obviously still negative. And over the next few years, over the next couple of years, it had this enormous move higher, as did obviously a lot of bond yields. Anyway, we're not here to discuss the Bund. We are here to discuss and to make a case for the T-note yield, the US T-note yield, the Treasury bond going to 8.5%. And as I said, no one else is talking about this. So there are three prongs that we're looking at here for this argument. One is inflation. Two is the demise of the dollar. And last but not least is herding behavior. So let's examine each one in turn. So let's start with inflation. Now, most people in the world right now think of inflation as price inflation. If you talk about inflation, if they talk about it on the news, it's about the price of groceries going up, the price of a tin going up, or the price of petrol going up. Now, actually, the actual pure definition of inflation is in terms of monetary inflation. It's the acceleration of monetary growth. So this is the US monetary base here from 1970, and you can see, up until the great financial crisis of 2008, it was a very steady sort of growth higher, in line with the growth of the economy as the way the money should grow. There was a little blip here for the Y2K panic, if anyone remembers that. It's a blast from the past. But look at what's happened from the great financial crisis of 2008. Obviously, there's been this incredible printing of money going on from the Federal Reserve and the US government, and repeated by many other governments around the world, of course. But you can see what this is like in terms of this graph here. Then what we're seeing from 2008 is definitely not normal at all. And this is the great inflation that we're talking about. And it's now beginning to feed through into prices. We had an idea that this might be occurring by looking through our Elliott wave lens at the commodity market. This is a commodity ETF, looking at the S&P GSCI index. And it's important here to realize that we had a 5-wave move up from a significant low, followed by a correction down. We then have this kind of sideways movement going on here. Now, the lower chart here is what is a measurement of volatility. It's called Bollinger Band width, but it's a very good measurement of range, expansion, and contraction. And it enabled us, looking at how low it was at this point on a sideways market, it enabled us to say, back in the end of last year, November, get ready for commodity volatility in 2026. And of course, we've certainly seen that in the last few months. So we think, given this Elliott wave lens, this is going to continue higher over the next number of years. Big driver of that, obviously, this year has been oil, which is a huge driver of commodity inflation and producer price inflation, and it feeds through into consumer price inflation, as we all know. But this is what we were looking at back in the end of last year. We noticed this very large 3-wave movement down from the great financial crisis into this low here, the historic low, where one of the contracts went negative on oil. We then had this incredible movement higher here in a 5-wave movement. I haven't put the 5 waves in, but again, what's important to realize here is when we see a significant low, and when we see a 5-wave movement higher from that low, followed by a correction, we're pretty sure that there's going to be another 5-wave movement higher in terms of the Elliott wave analysis. So this analysis enabled us to say, at the very start of this year, in January of this year, on the 7th of January, that a multi-year advance in wave C of this measurement here to above $130 a barrel should ensue. And, were we to know that there was going to be an event that took place, which people obviously ascribed to the reason that oil went higher? Well, no, but the herding behavior, the analysis of human herding behavior, was telling us that something was likely to happen. As I said earlier, the price tends to move before the news comes out. So what we're looking at here in terms of oil, just to zoom in just a little bit, we've had this 5-wave movement higher, followed by a 3-wave correction. What we're looking at right now over this week is a really interesting happening that's going on, the correction has stalled and started to move higher again. Oil started to move higher again at this very significant 78.6 or 0.786 retracement. Again, all the details are in elliottwave.com if you want to get into details, but it is a very significant ratio where second waves tend to turn. But it also turned, this coincided with the gap in oil when the war started back in the end of February, start of March. So this is a really significant development in oil, and it increases our confidence that oil is now set for another move higher, which should increase inflation. Now, inflation is obviously always increasing already. This is the Fed's preferred measure of inflation, the PCE pricing, so the core index, and this is accelerating higher here. Now, gold is an interesting market because actually we've done studies over the decades which suggest that the relationship between gold and inflation is pretty unstable over the short term, meaning a kind of multi-month, multi-year kind of span. But over the very long term, multi-decade kind of expansion relationship, then there is a relationship there. But what is interesting for us now is that as gold had gone sideways when inflation was quite rampant in 2022, 2023, it then took off. We noticed using our Elliott Wave lens again back in December 2023 when it was trading here around about $2,000 an ounce, that we said gold looks like it might be about to take off, and obviously that's what's happened. Now, this high here in January, we managed to sort of again nail because of the huge volume. This was remember all the hype at the start of January in gold was going to go to the moon, and there was huge volume. When you see that in any sort of market, it's a big warning sign that there could be a blow off, well, on the downside or the upside. So we're viewing this as what we call wave 3, which means that wave 4 down is happening now. But the conclusion is that that means that wave 5 up is still to go, and fifth waves in precious metals to the upside can be very exciting, very spectacular, and very long indeed. So more advancement in gold to come over the next few years, and that would speak again to this idea that inflation is on its accelerating trend. Now, talking about gold and how this massive monetary inflation that we've seen has really, kind of overtaken everything over the last 15, 20 years. This is obviously the Dow Industrial Average from 1970. And you can see that we're at the highs. Everyone's celebrating. Yeah, we're at the highs of the stock market. Everyone feels richer. Your 401k, etc., etc. But are we actually richer? Does anyone actually feel richer? If you look at the Dow in honest money, i.e., not in dollars, the top graph is showing it in dollars, which can be printed, which we've shown has been printed massively. If you look at it in honest money, like gold, the Dow it peaked in 1999. And it has been on a downward trend ever since. So, this really speaks to the idea that what we've seen has been a big, big bubble, which could be, which we think is likely to burst. And this last graph here on the inflation aspect speaks to that as well. This is the Dow adjusted by money. And you can see that we're not even back at the 1926 level of the stock market when it's adjusted by the money supply. So the next aspect of why we think an 8.5% T-note yield is the dollar demise. You can see that this is the federal government current expenditures on interest payments, currently running at a rate of 1.2, 1.3 trillion dollars per annum, which is way higher than the defense budget. And people smarter than me have said that when that happens, that usually means the kind of end of empire, which is interesting, and it's obviously very unsustainable. But this end of empire thing is is interesting, because if you look back in reserve currencies, which obviously the dollar has been the dominant reserve currency over the last 100 years or so, more than that, there is a kind of a 100-year cycle, a century-ish kind of cycle going. Back to the 1400s, you had the Portuguese dinero, which was in use. That was the main reserve currency. Then you had the Spanish dollar, or the piece of eight, during the 1500s. You had the Dutch guilder in the 1600s, the French livre in the 1700s, the British pound in the 1800s during the Victorian era. And since the late 1800s, it's been the American dollar, which has been the main reserve currency in central banks around the world. That is obviously now, that century-ish cycle is coming to an end. So it's ready for someone else to take over. And I wonder who that could be. But what we really like to do, obviously, is look at things very objectively through our Elliott Wave lens. What we noticed at the start of 2025 was this pattern here in the dollar index, and we said that we expect a significant decline in the dollar to be one of the highlights in 2025, and that turned out to be the case. What we think is happening now, since this low here in 2025, is that this is a corrective, what we call a corrective advance. So this is wave two of a 5-wave movement down here in the dollar. So we expect, once this corrective advance in the dollar is done, for the dollar to resume its long-term downtrend. One of the things that speaks to that, speaks to this kind of end of empire thing, is the fact that people are beginning to question the creditworthiness of the US. Again, speaks to this idea that the reserve currency status is dwindling. This was the start of the war. This is the credit default swap, the price of insuring against a US default. And you can see how it's risen here. And gold is already replacing US treasuries in some central banks' balance sheets. So who can take over? Well, obviously the obvious candidate would be China. You can't really put an Elliott wave count much on it at the moment because it is still quite controlled. But it is interesting to us that from all this, when it started to float in 2005, it has retraced at the 61.8 or 0.618 inverse of the golden ratio level. So that is interesting to us from an Elliott wave perspective. Okay, and last but not least, in terms of why we think the case for an 8.5% T-note yield is herding behavior. This is the bedrock of what we look at. So this is the US T-note yield here, going back to the 1960s. Obviously, we had this huge movement up here in the 1970s, followed by an incredible long, decades-long movement down into this low in 2020. Now, as opposed to the stock market, bond yields, because they're kind of limited, they don't go to 100, 200, 300%. Well, sometimes they do, but they're not going to go on forever. They go up and they go down. So, but it's driven by human herding behavior. But they tend to move in really long cycles of 3 waves. Okay, so this was the end of a cycle here, when wave C in the early 1980s. This long movement down here is what we're labeling as wave A. And at the moment now, we're just starting a long movement higher in wave B. So just going into that in a little bit more detail, and again, don't get put off by the labels, because you can look at this in elliottwave.com. But wave A consisted of 3 waves. We had a 5-wave movement down here into the late 90s, a corrective B wave, and another 5-wave movement down here into this low in 2020. Now, since 2020, this is the real nub of what we're looking at here. So we've had a movement up here, which what we call is an impulsive movement. That means it's 5 waves. And go back to what I was saying earlier on, if we see 5-wave movements up, a 5-wave movement up from a significant low, then it tells us something about what might happen next after the correction. So we're labeling this as wave A. We've had a wave B here, which we call a triangle, and we'll go into that in a bit more detail in the next slide, the last slide. what we can say is that there's a ratio, a relationship which often exists, is that wave C of an ABC movement will equal the length of wave A. So if that was the case in this case, that would come in 8.63%, which also happens to come in pretty close, just above the 50% retracement. Again, quite a retracement that often happens of the entire movement down from 1981 to 2020. And also, what we can draw here is what we call an Elliott channel, which is a predictive channel. So we join the start of wave A to the end of wave B and parallel that off from the end of wave A, and it gives us an idea of at what level and when the wave C might end. And that looks like it's coming in around the 8.5% level in a few years' time. Okay, so this is the last slide, really just to go into a little bit more detail as to why we feel confident that this is the right analysis. So this is the move up from 2020. You can see the clear 5-wave movement here from 31 basis points into 5.02% here. Now, this is what we call a triangle, and they're one of the most reliable patterns in Elliott wave analysis. And what makes us confident that this is the correct analysis, within a contracting triangle like this, what you'd like to see and what Elliott discovered was that the internal ratios, some of them tend to be related to the golden ratio. So what we see here is wave C was 0.618. 0.618 is the inverse of 1.618. It was 0.618, the length of wave A, and wave D was roughly 0.618, the length of wave B. So this tells us, once the triangle was completed at 392, that we're now into this movement higher here, which probably isn't going to happen overnight. It will take a few years, but the target that we've got, and the reason we're making this case, is that it's 8.63%. Okay, so just as a summary then, the case for an 8.5% T-note yield, we think price inflation is going to accelerate, led by commodities. The dollars should continue to depreciate and very much have its reserve currency status diminished over the next few years. And herding behavior points to another surge higher in the T-note yield. 3.92% is the key pivot for us on that. If we went below 3.92%, then we'd have to think again. But as things stand, we're confident in this analysis. So that's it from me. I think I've got a few minutes left. If you, as I say, if you want to find out everything there is to know about Elliott wave analysis, elliottwave.com is where you want to go. If you are a fixed income and currency professional, family office fund, etc., we have an offshoot called Global Rates and Money Flows. You can work with me directly with consultations, on-site meetings, and in-person training. So if you want to learn more about that, that's elliottwave.net. So without much further ado, I will leave that there and see if there's any questions, Marquis.
Yes, great presentation. We do have a question. Someone asked, how should long-term investors prepare for how should long-term investors prepare for the possibility of sustained higher interest rates without overreacting to short-term market moves?
Well, cash is obviously a good thing. What we're thinking about is long-term interest rates going up. Obviously that will be detrimental to long-term bond investors. So being at the short end of the yield curve would be the best thing to do. Our thesis is that with interest rates going up, especially the T-note yield, which influences everything, then it should lead to lower equity valuations. And that very much ties in with our equity analysis using the Elliott wave lens, that we think that equity markets are going to come down. So we view a kind of stagflationary environment over the next few years. So being at the very short end of the yield curve would be the thing to do.
Awesome. And someone else asked if 3.92 is breached lower, how much lower?
Well, given the five-wave movement up from 2020 into 2023, and given the sideways movement there are various options. If 3.92% is broken, it negates the triangle analysis that we have there, which we've just presented. But what it doesn't negate is the fact that there's been five-wave movements up, initial five-wave movements up. And so that means that the movement down from 2023 high, from that 5.02%, is still corrective. It just means that the correction lower in yield, sideways to lower in yield, is taking a little bit more time before we move up again.
Perfect. We have one more question. Someone asked your presentation reference Treasury trends dating back to the 1960s. What historical lessons do you think are most relevant for today's investors?
Well, I think what happened in the 1970s, you had your bond yields, way up in 20% level. You had the Fed funds up there as well. So, we have a precedent for what we think is going to happen now, and the kind of 1970s model tends to be, what we're looking at. And you had, was it Mark Twain that said history doesn't repeat but it rhymes? Then we had price shocks there. We had oil shocks in the 1970s, and that could be what's happening now.
So we actually have a few more questions. Someone asked, is there a risk of the government putting yield control and prevent the yield going up on your target?
Very much so. I think there's, some people, there might be on the fringes at the moment, but some people are already talking about, what the US Treasury is thinking of doing. It's obvious that they have started to put their issuance of treasuries towards the short end of the yield curve. And that in itself is a kind of panic measure that they, if they thought they were a good borrower, then they would be issuing 30-year bonds all the time, and doing that. But by issuing at the short end, they're thinking we just want as much money as possible, much debt, and turn it over as much as possible in the short term. So there is a bit of a panic going on there. So they might do something radical, like impose some sort of yield control or some sort of turning bonds into perpetuals, for instance, where they don't have to be repaid. This all ties in with the charts I was showing there, the analysis of the demise of the dollar as a reserve currency.
Great. We have one more question. Can QE destroy the vision and play out in gold, like what happened before in 2000 with the DJ top?
Yeah, I think if I'm understanding the question correctly, you're saying can QE destroy the markets, or make the markets not behave they normally do, or they should? Then the answer is yes, absolutely. You just look at what's happened since QE came into the lexicon after the great financial crisis, and you can see how much distortion there has been, whether it's gold or bond yields or swaps or anything like this. There's been a huge amount of distortion going on in the market, especially with the stock market, and that is all looking like it's coming to an end now.
Awesome. Well, that is all the time that we have today. If you all do have any additional questions for Mr. Gunn, feel free to contact him directly, and make sure that you engage with Elliott Wave. With that said, we still have presentations going on today with our Investing in Alternatives Virtual Expo. So make sure that you tune in for that. And thank you, Mr. Gunn, for your time today.
Thank you, everyone. Thanks.